Tim Anderson, we're behind the scenes on Wall Street on a Friday. This week we saw a rotation from growth to value, some more action in the bond market. Tim, talk to me, what happened?
Well, the week started out with just this massive unraveling of the long growth, short value trade that has been such a winner and that so many hedge funds had such large positions in, that it caused just a lot of volatility on the first two and a half days of the week, where the really beaten up stocks rallied hard. The stocks like McDonald's and Starbucks and other growth names that have been trading way up at their highs came off 5, 6, 7, 8%. And then that created this big argument among people in the market as to whether this was just a short covering rally. A lot of times traders don't like to see the worst performing stocks act so well like they were doing Monday and Tuesday. I happen to think it's possibly more of an asset allocation trade within the equity space, where people are maybe setting up a little bit for the fourth quarter, selling some of their winners because they just think maybe there's limited upside from here. They've got big gains they'd like to book. But also this bond bubble that we were in 2 to 3 weeks ago.
Violent, right? You're calling this violent.
This was a violent, vicious move in the bond market. And we talked pretty loud and upfront 2 weeks ago about being in a bond bubble. It's always hard to tell exactly when that bubble is going to burst. It's hard to tell how extreme it might get. But 2 to 3 weeks ago, when the 10-year yield went below 1.5, 2 or 3 times, a couple times even for a couple of days, and the 30-year yield went below 2%, that has unraveled also. And that really, in hindsight, was a panic to safety trade that created that bond bubble. The yield on the 10-year has gone from 1.45% to 1.79%. The yield on the 30-year has gone from 1.9% to 2.25%. Those are massive moves in the bond market. You only see moves like that in a very short period of time, once every few years. And that has squashed the recession fear talk. We haven't heard anything about it for this week. It's also destroyed this short value trade that the market was so heavily invested in.
All right, now that makes sense. Now we have the Fed finally next week. Are you still sticking with that 50 basis point change, or did you change that?
You know, they could do that, and I just think I have to back off that 50 basis point cut because of such of a strong move that we've had in the bond market this week, with the 10-year right now at 1.79%. If the Fed cuts 25 basis points, that brings their bound on the Fed funds rate to 1 3/4 to 2%. So if it were to trade freely at the low end of that range, 1 3/4 or 1.75, it would be very much in line with where the 10-year is. We'd like to see it lower than that to get an upwardly sloping curve. But with the strength we've seen in the market and with the sharp sell-off in the bond market, I just think it would be highly unlikely to see them cut 50 basis points. I'm sure they're still going to cut. It looks like it's going to be a 25 basis point cut. That will get short-term rates in line with the rest of the yield curve. There's still a little bit of correction to do, a couple different areas of the curve, but this will help. This will just help the underlying structure of the whole financial market be more normalized.